Welcome traders, welcome to our new market update. This one will be about our portfolio performance in last few months, about single strategies performance. We will check the performance of different trading approaches, and we will also check the differences between portfolios we are trading for our retail clients, our free clients, or our institutional clients. Okay, let's start. Well, firstly, let's check our in-house built index. This is the equally weighted index of top 50 biggest coins on Binance Futures. You already know that our trading universe is top 50 biggest coins by volume, and this is exactly what this benchmark shows. You can see that we are hitting 4 years low last few days. Really, the market is tough. And by tough, I mean that this index is in a drawdown of almost 70% since the top, which was made in December 2024. And being in a drawdown of 70% means that you have to make minimum 233% to get back to break even. So really tough conditions. And let's look once again to this benchmark. You can see that from the top of 2021, we are very far from that. Really, I have to repeat again, crypto is the market for trading, definitely not for investing, because being here means that you would have to hope that the market would have to make minimum hundreds of percents to get back to previous all-time high. Really, crypto is tough to invest, much better to trade thanks to the volatility. Drawdown once again, we are in a drawdown on this benchmark of almost 70%. Very tough. Now let's look at the performance of Robuxio portfolio compared to the broad market, because on this chart you can see the performance of all tradable coins based on CoinGecko. You can see that by far most of these coins are in a drawdown of -80, -60, -50%. In fact, the average drawdown, this is the performance of last 3 months, the average drawdown of this universe is 60%. 60%, huge one. Where are Robuxio portfolios? Well, this is pretty interesting because our Lite portfolio, which is the portfolio everyone can trade for free, is in a drawdown of -10%, which is great because don't forget that this portfolio is trading to the long side only, which means that in an environment which is nothing but falling, really cannot make any money. Its task in these conditions is to keep profits or to keep as low drawdown as possible, definitely not to make money. On the other hand, our standardized portfolios, the ones who are including more of longer term trend following strategies, are in a drawdown of -0.5% to -7% in last 3 months, and our institutional portfolios are in a profit of 14 to 20%. Actually, I'm recording it on Monday, March 10, and today the situation would be much worse for the broad crypto market and much better for Robuxio portfolios. These standardized portfolios would be maybe in green, definitely almost in no loss at all. And our high share portfolios are between +23, 24% or +15, 16%. And one more point here, there is, for example, Trump or Bera or IP, but most of these coins weren't even tradable on Binance Futures from the inception. For example, Trump coin right now is in a drawdown of dozens of percent on Binance Futures. So really, these portfolios are doing very, very well, especially compared to the whole market. Once again, here there are the Robuxio portfolios, and look at the performance of the broad market. That's huge. Almost everyone is bleeding these days. We are in connection with many different trading companies in crypto, professional ones, and I can tell you that many of them are really going through deep drawdown. So I'm really very satisfied with where we are in terms of performance. Okay, back to our strategies, back to the approaches we are trading. So firstly, let's look at momentum long strategies. Momentum long strategies are trading based on the idea that if something starts trending to the long side, in this case, it usually continues trending the way. And you can see that we are trading a few momentum long strategies. We are trading Volatility Catcher, we are trading the Moon, we are trading Puncher, we are trading Flow, and we are trading TrendCatcher. What I wanted to show you are the differences between the strategies, because some of the strategies are doing really great, like for example Volatility Catcher or the Moon. On the other hand, not every strategy is making money in the exact same time. And that's the reason why we have so many of them in the portfolio, because look at the Moon strategy, for example. The Moon strategy is trading based on the idea that if market is breaking through all-time highs, there usually tends to be pretty strong edge to the long side. But because most of the coins weren't breaking through all-time highs since 2024, March 2024, you can see that the strategy is nothing but losing money, which is perfectly okay, because whenever we will be in very strong momentum long conditions, this strategy will push again. On the other hand, Volatility Catcher or, for example, Puncher are the strategies which are making money only from smaller movements, and that's why they are able to deliver profits even in not so great momentum opportunities. And let's look at TrendCatcher. TrendCatcher is the strategy which is made to make money over the long term in very trending environment, and you can see how much it made in 24. On the other hand, it also made in 24 in the fourth quarter, but it returned back most of the profits. Why? Because if we are targeting long-term trends, we also have to keep a lot of space for the strategy, and that's why it's making money, but it's also giving a lot of money back if the market reverts very quickly. So these are the differences between momentum long strategies. Then we are trading momentum short strategies, and it's even more interesting, I think, because we are trading, for example, Bearish Bulldozer, which has really horrible equity curve. We have even worse, we have TrendCatcher short. But why are we having them in the portfolio? Because TrendCatcher short in very trending environment to the short side will make the most money from all these strategies. The reason why it's not making that much money so far is because we weren't in these opportunities yet. It doesn't mean that these opportunities won't come in the future. On the other hand, for example, Plunge or Quick Bite are strategies which are made to make money more often. They don't need such a big movements and long-term movements to the short side, and that's why they are more stable, because very honestly, finding proper edge to the short side is very hard in crypto. It's also hard in stocks, and in crypto it's similarly hard. So that's why the equities really don't look that well, but together in the portfolio they have for sure their space. And this is also the reason why our portfolios are making money these days when everyone is bleeding, when many cryptocurrencies are in a drawdown of 50, 60, 80%, because these strategies are pulling these days. Then we have mean reversion long strategies. And you can already see that mean reversions long strategies compared to, for example, momentum long strategies are much more stable. You can really see that the trend is pretty obvious across all the mean reversion long strategies. Of course, some of them are making money in the strongest momentum, another one are making money, for example, in more sideways market. But that's the mix of mean reversion long strategies. But in general, mean reversion long strategies, even short strategies, are more stable. That's why we keep them in the portfolio, even though they are not making that much money in absolute terms compared to momentum long strategies. But here is the main difference between standardized portfolios, which our retail clients are using, and institutional portfolios, which our institutional clients and performance clients are using. The main difference is that these portfolios are a little bit heavier in mean reversion strategies, and they are not using that many longer term momentum strategies. Why? Because we are targeting bigger stability over the short term. On the other hand, our standardized portfolios are targeting higher absolute returns over the long term. So then the question is, what portfolio is better? It's also about patience. But let me get there a little bit later. Then we have mean reversion short strategies. Again, they are making money when we need it. It means that they are making money if the market is falling. And that's the reason, again, why we have them in the portfolio. You can see, for example, in last 3 months, how these strategies are almost all of them making some profits. And again, that's the reason why we have them in the portfolio, because these are definitely not big money makers. They cannot deliver a profit of 50, 100% in a year. Definitely not. This is for momentum long strategies. But together in the portfolio, they definitely have their strength. Now let's look at the performance of different portfolios we are trading for our clients. This is the performance of Robuxio Lite portfolio, which every client can trade with the account of maximum 5,000 USDTs. And this is long only portfolio, which is trading 3 strategies. You can also learn how to build this portfolio in our course. Then let's add the retail portfolio, our standardized high risk portfolio. Right now it's in a profit of 7-8% in last 3 months without today, because today it's definitely pulling maybe close to 10%. But again, compare it to the benchmark. In this period, the benchmark is in a drawdown of over 60%, 65% maybe. So huge positive result. And now let's look at the institutional portfolios compared to our standardized retail portfolios. There is definitely difference, and the main difference is in the volatility, because you can see that if the market is, for example, here heavily falling, all these portfolios are making more or less similar money. In fact, high risk standardized portfolio is making the most. On the other hand, it's paying for this extra profit with higher volatility. You can see it here. Our high risk standardized portfolio lost more money in this downturn, while our institutional portfolios were much more stable. And this is because in this sideways environment, our longer term momentum strategies like TrendCatcher, for example, were losing money, while our shorter term momentum strategies were usually out of positions. And that's the main portfolio. You can see the same behavior here or even here. And that is the price we are paying for possibly bigger absolute returns. The bigger returns will come only in the time of very strong trend. And that's why we are thinking and we made a decision that we will offer our institutional portfolios even to retail clients. We will give you more information in a week, and if you would be interested, we can switch you. But just for you to know, everything has its advantage and disadvantage. The same here. Yes, our institutional portfolios right now are really one of the best I have seen in last 3 months across the crypto market. On the other hand, whenever the market really starts pushing to the long side with very, very strong momentum, these institutional portfolios could slightly underperform compared to the standardized retail portfolios. We are always paying some price, volatility versus potential higher profits, or more stable portfolios with slightly lower profits. So this is what I wanted to show you today. We'll provide you more information on the difference between the portfolios, and then I will keep it up to you if you would want to trade standardized portfolios or you would want to go with the institutional portfolios. Okay, thank you. If you have any questions for the next market update, please write me, ask us anything you have in your mind. We are always happy to answer. Have a great day. Bye.